How's it going, everyone? Bill Lethman here for Money Evolution. In today's video, I'm going to be talking about planning for an early retirement. Now, in this video, my definition of early retirement is going to be anything before your full retirement age. That's the full retirement age for Social Security purposes, which for most people right now is going to be age 67. So, in fact, when we do our Retirement Time Machine Quick Start workshop, we actually help people walk through the worksheets, and we actually help them calculate the retirement cost from their full retirement age through the rest of their life and how much that's going to cost. But then we also help them calculate out what that early retirement is going to cost as well. And the reason why we do that is because if you think about your retirement situation, in the early part of retirement, that's one of the reasons why I made this video, is because early retirement, there's going to be a lot more variability to some of the retirement things that may be going on. Whereas after full retirement age, you're probably going to be getting your Social Security benefit. Of course, you could delay it to as late as age 70 to get some delayed retirement credits, but you're going to be getting Social Security. If you have a pension, a lot of times those pensions may kick in at 60 or 65, so you have that. Things sort of normalize a little bit more after age 67, whereas early retirement, there's going to be a little bit more variability. So I think the first step to planning out this early retirement is to really understand what some of those different moving pieces are. And we can talk about an early retirement that's going to be after 59 and a half. Meaning that you can start taking normal distributions from your retirement accounts. So between 59 and a half and let's say that age 67, in that period, what do we have to think about? And then if you're planning to retire before 59 and a half, there's going to even be some more special considerations you're going to have to think about, because you may not have access to all of your retirement funds retiring before that 59 and a half, when you can start taking those normal distributions. So now, one of the ways that we do this, and you may have heard me talk about this in some other videos, I'm very big on what I call the timeline. And again, in that Retirement Time Machine Quick Start workshop, we've got some worksheets to help you walk through that. By the way, if you want to learn more about that, we've got a link, I think, right below this video here where you can check that out. But for example, you may be retiring, let's say, at 55. Maybe you got an early retirement package, or you've vested your pension and you can walk away from your job at 55, but maybe your spouse needs to work a few more years, and let's assume you're the same age. Maybe your spouse has to work until 60 to get some of their retirement benefits. So even though you're going to be retiring at 55, your spouse may have some additional income coming in. Maybe you can cover all of your expenses with just your spouse's income, but maybe you can't. So what's going to happen here is you're going to identify and you're going to want to figure out what your gaps are. And so you may have a period of time where your gaps are going to be maybe a little bit smaller for those first 5 years or so. And then maybe as you're both retired, your gaps are going to be much larger as you're waiting to get from age 60 to age 67. So you're going to want to understand what those gaps are and how much money you may need to start taking from your investment accounts during those early years of retirement, and kind of adding it all up. And again, the way I would recommend doing it is looking at how much it would cost to fund that full retirement age amount at 67, but also look at how much it's going to cost to fund the early part of your retirement. Okay, so now let's talk about some of the things that I think you're going to need to consider as you're planning out this early retirement. And let's begin with those individuals that are, let's say, under 59 and a half, because there's going to be some really special considerations there, because again, you may not have easy access to all of your money. But I do have some good news. There are a couple of ways that you can access the money that's in those retirement accounts even before age 59 and a half. And the first of those is going to be something called the age 55 rule, and that's going to apply to 401k plans. So if you have a 401k plan, as long as you separate in the year that you turn 55 or later, even if you're not yet 59 and a half, you can take penalty-free withdrawals from that 401k plan, and you can use that to cover some of those gaps that we talked about earlier. One thing that's very important to note here, though, is if you take that 401k plan and you roll it over to an IRA account, you will not be able to use that age 55 rule. So that's going to be very important before you do any rollovers, is understanding if that's going to be applying to you, and if you're going to need to take that money, then you're not going to want to move that money over to an IRA account, because that age 55 rule only applies to 401ks. Now, there is an option called 72T, which does apply to IRA accounts, and you can do 72T on an IRA, but you can't do it on a 401k plan. But 72T basically says that as long as you take out what are called substantially equal payments over the greater of either 5 years or until you turn 59 and a half, whichever is longer, you can avoid that 10% penalty on those withdrawals. So a couple things to really think about there. Of course, if you're under 59 and a half, if you have any money in non-retirement accounts, in fact, if you're really planning on it, that may be something that you want to try to build up some money in those non-retirement accounts. And of course, if you take money out of one of those, you may have to sell something. There could be some capital gains, short or long term. You could be having some interest that you have to think about for taxes or dividends. Some of those dividends could actually be what's helping you to fund some of those gaps. I've had some clients recently that had very large dividend portfolios in those non-retirement accounts, and that became a critical or key part of their retirement strategy, is having those dividends cover some of those gaps there. But those non-retirement accounts could be another option that you could have for accessing money and filling up those gaps. But again, remember, the first step in that is understanding what those gaps are and then figuring out which accounts and what options you have for getting that money out. Now, another thing you're going to want to do as you're working towards planning for not just an early retirement, but really any retirement, is you're going to really want to understand what are some of the benefits that you have through your employer once you separate service or once you go through retirement. So you're going to want to understand things like how your pension works. You're going to want to know specifically when you could turn that pension on. Maybe you have a lump sum option. Those are things that get a lot more complicated as far as a decision goes of deciding which one to go with. But you're going to want to know what that pension is. If I retire at age 60, what would my benefit be? And then you're also going to want to know, well, what would that be if I worked until I'm 65? How much would that go up? Or if I retired at 60, but I waited until 65 to collect, what would that be? And those are things that you're going to want to understand. Doesn't mean that you can't retire if you're going to be giving up a lot of money there, but you want to know what that money is. You want to know what you're leaving on the table, and also make sure that you're in good shape financially so that you can do all the things that you want to do in retirement, that you're in good shape. Of course, for most people, every extra year you work is going to make your retirement situation look better, at least from a financial standpoint, but we could say that for the rest of our lives. We could be 80 years old saying, if I work one more year, it's going to look that much better. But we want to understand things like our pension plan, what that is. We want to understand what some of the options are, like on our 401k. If we leave it there, most plans, I think, do allow you to leave the 401k plan there. You could roll it over. Basically, you have 4 options with a 401k. You could leave it in the plan. You could roll it over to a new 401k plan if you're going back to work somewhere else. You could roll it to an IRA account, or you could cash it out. Of course, if you cash it out, you're going to have some taxes to pay on that, potentially a penalty. They're going to be required by IRS rules to withhold at least 20% for taxes, but your taxes and penalties might actually be well above that 20%. So you know what your options are on the 401k. If you have an outstanding loan, that's going to be something you're going to want to know how that loan is going to be treated. Is that loan going to be required to be paid off immediately upon termination from your company or separation from your company? If you can't pay that loan off, it may become a taxable event. And that's something that you really want to think about. You also could have some penalties on that loan as well, too, if you're not 59 and a half or age 55 in this case right here. So you're going to want to know how that loan is. Some 401k plans do allow you to continue making payments on the loan, but you're going to want to really understand how that works there. Another thing you want to know from your employer is if you have any health care options. And you may have, you would have the ability to do COBRA, for example, for up to 18 months after separating service there, but your employer may allow you to stay on the company plan. Maybe you have to pay the whole thing. Most plans are going to be subsidized through your employer, so if that's the case, you may have to pay the full boat or maybe some other retiree rate or something like that, but you're going to know what those options are. And again, kind of going back to our earlier example, if you're married and maybe you're retiring but your spouse is still working, that would be something to look into too. If you're retiring and you're giving up your health care benefits, that might be an option to go on your spouse's health care benefits at that time. So those are going to be things you're going to want to look into and make sure you understand what all those different options are. Kind of going along with health care, not necessarily through your employer, but you're going to want to look at other options. If that COBRA runs out, Or maybe you decide to go with the Affordable Care Act and look at what the exchanges can offer in terms of health care. You're going to know what the cost is going to be there. Some people, when we work out our financial plans, are working towards qualifying for an ACA subsidy. If your income is under certain levels, we can keep that cost really down quite a bit. But you want to know what those discounts are, so the subsidies, and what that cost is going to be if you don't have that subsidized. And again, that may be a very big portion of what your retirement expenses are, at least in those early years. And then also too, as you're doing your retirement plans, you're going to want to look at Medicare. Now that's not until age 65, but again, what we're calling early retirement here is anything under age 67. But as you're doing the retirement plans, you want to be aware of what the costs are going to be, not only for your early retirement, but what that's going to be after full retirement age as well. And that Medicare is certainly going to be one of those expenses. So as you put this all together, one of the things you want to do and really make sure that you're aware of is, again, understanding what those gaps are, and then looking at how you're going to fund those gaps. And this is not just for people planning an early retirement, but even people that are planning retirement after full retirement age. But generally, we're going to see larger gaps in our clients that are retiring before their full retirement age because you don't have a lot of that income coming in, and you're most of the time relying almost exclusively on the assets that are in your portfolio. So we oftentimes, and I'm not going to get into a ton of detail right here, but we recommend a bucket strategy to have money to fund those early gaps. We recommend keeping, at least initially, about 2 years of your cash flow needs in something liquid and safe. It could be something like a money market account, checking savings accounts, certificates of deposit even in there. And then we want to have another 3 to 5 years in something that's going to be somewhat liquid, still something that's going to be on a little bit of the safer side there. That could be traditional fixed income and investments like that. There are risks with bonds, so you want to be really careful. Just because it's a bond or even a treasury doesn't mean that it's not without some variability of returns. Even treasuries go up and down depending on what the interest rate environment is there. So you want to be aware of that, but you want to have some things in that middle bucket and making sure that you have some ways that we can continuously come back over and replenish that bucket. Bucket number 3 generally is going to be our growth bucket. That's where we're going to have sort of our inflation hedge there. So we're going to have something that's going to hopefully keep up with inflation long term. And as you kind of go through some of these early buckets, you can constantly be filling that bucket up. So you're not having to hopefully go in and sell investments that may be more volatile and having to sell those investments when the market may be down in value and locking in those losses. So you want to have a plan for income there as you go into retirement. Now, another thing we're going to want to take a look at here as we're planning for an early retirement is we're going to want to do a little bit of advanced tax planning. So one of the things that we see oftentimes for people retiring early is that, let's say you're retiring at age 60 there, is we end up with what are called, or what I call, some low tax years. And that's because we don't have as much income coming in. Maybe we're using up some money that's in a non-retirement account to use as our living expenses for those first couple of years, so we end up in a very low tax bracket. Some people are just really excited about that, saying, hey, I retired and I'm not paying hardly anything in taxes. How great is this? But they completely miss the opportunity, because what ends up happening is later on, as Social Security starts to kick in, as your required minimum distributions kick in, and as maybe that non-retirement account runs out of money, we end up having to take more and more of our required gaps or needs from some of those traditional retirement accounts, and that pushes our tax bracket up later. So this is something that we do in our retirement planning program called the Retirement Time Machine, and we help people to identify, this is something I did in a different video, but we help people to identify some of those low tax years. You can see here's a situation where somebody's working, their early years here where they've got some lower taxes, and then later on as those taxes start to go up there. So the opportunity there for a lot of people is to maybe start shifting some assets between those different asset type buckets from the traditional retirement accounts to Roth retirement accounts. You do that through a conversion and you pay the taxes, but you're hopefully or ideally paying those taxes at a lower tax rate today versus what you think that tax rate is going to be in the future there. So not missing out on some of the tax planning strategies and understanding maybe where you fall in the gap and things like that. is going to be what we're going to want to do during those early years for the early retirement planning. The last thing I'm going to talk about here just real briefly is if you're retiring early, you really want to know what are you going to be doing? And I think that's something that a lot of times people don't really think about. Maybe they're stressed out with their job, they don't like it, they don't like the commute, there's a whole bunch of other things. They say, I got to get out of this, I got to retire, and then they retire and then they're stuck, they don't really know what to do. They say, well, I'm going to play some golf, but you can only play sometimes so much golf, maybe other hobbies and things like that. But you really want to be thinking about what's going to fill up that time and how you're going to basically go through your daily routine. What are the things you're looking forward to in retirement, and what are the things you're going to miss maybe with the job that you have, some of the friendships and some of the structure and things that you might have there with your job. So anyway, hope that's helpful. Planning out your early retirement takes a little bit more care and strategy maybe than what might happen at full retirement age when you have a little bit more of some of that income coming in, especially for most people. Once you start getting those Social Security benefits, that's going to reduce those gaps. So again, planning for those early retirement years, the bigger gaps, how you're going to get the money out of the retirement accounts, that's all stuff that really takes some extra planning. So anyway, with that, be sure to hit that like and subscribe button if you liked the video here today. Check out some of the links down in the description below. There you can learn about our comprehensive financial plan called Wealth Vision, or you can go to wealthvisionplan.com. That's our one-on-one service where we walk you through and help you to create that financial plan, working with me directly on that through a series of meetings. And then we also have our Retirement Time Machine program, which is a little bit more of a DIY. I've got, I think, about 13 hours of video that are in the course, all of these worksheets and things, but we actually help you to build the actual financial plan using the same software we use for our high-end clients. There's some advanced features and things like that that are just for the Wealth Vision plan, but you're going to walk away understanding what those gaps are, understanding how your tax rate's going to evolve and change over time, and then really helping to work out through some worksheets a good retirement strategy, taking withdrawals, which accounts to withdraw from first, and kind of building this out. So anyway, check out those links below. Thank you for watching the video, and I'll see you back soon.